Okay, hello, good afternoon. Thank you all for being here. Today is Tuesday, September the 15th, and this is a live webinar on federal estate tax planning. My name is Ashley, and I'll be introducing today's presenter. But first, a little background on who we are. Russo Law Group has been focused on elder law, special needs, and estate tax planning since 1985. With over 30 years of experience, we've had the privilege of serving over 17,000 families in 4 convenient office locations, including Garden City, Islandia, Lido Beach, and Manhattan. We are a large firm. Team Russo consists of 6 partners, 4 associates, and just under 20 case managers and support staff. Our attorneys have received numerous awards for their dedication, and Russo Law Group is ranked as a best law firm in the area of elder law by the U.S. News. Finally, don't forget to join us for our next webinar in this series that will be on October 20th at 1 p.m. Okay, moving on to today's presenter and managing partner, Vincent J. Russo. Vincent earned his Master's of Law in Taxation, and he's a certified elder law attorney. He's a founding member, fellow, and 5th president of the National Academy of Elder Law Attorneys. He's co-founder of the Teresa Alessandra Russo Foundation for Children with Special Needs. He's also the author of the seminal treatise, New York Elder Law and Special Needs Practice for Lawyers Practicing in New York. I just want to remind everyone that this is a live webinar, and you may type your questions into the questions box provided on the Zoom toolbar. If you're on Facebook, you can use the comments section. Finally, a brief survey will appear automatically in your web browser when you leave the webinar, so kindly take a minute to leave us your review. Okay, thanks for your attention. Vincent, if you would, please take us from here.
Okay, thank you so much, Ashley. Welcome, everybody. This is part 3 of our estate tax planning series. Every time we finish one of our webinars, Ashley and I get together and we speak about it, and then I think, well, there's more to be said. So we're literally thinking there'll be a part 4 and even a bonus round part 5. So previously, if you missed the first 2, we touched on the nuts and bolts of estate tax planning. And then we, in the second webinar, focused in on New York State estate taxes. Today, we're going to be focusing in on federal estate taxes. What if I have a taxable estate? What should I be thinking about and doing, and why should I care? What are the strategies that are available to save estate taxes? And then what do I do next with all this information? So with that, let's jump right in. So, little background, things you need to know. You need to understand what the overall size of your estate is. You have to be honest about the value of assets that you have. When you're doing planning, you have a confidentiality arrangement with your lawyer. We're working for you. And so we really need to understand the full value of your estate. That would include the fair market value of real property, your businesses, if you have a business interest. Life insurance would be at death value, not cash value. So we add it all up to figure out what your overall size of your estate is. Then we look at the federal and New York State estate tax exemptions to see if you have a taxable estate, either by New York, if you're a New York resident, or federally. We also want to think about the concept of step up in basis, which is that if you have appreciated assets and pass away, the basis in those assets step up to fair market value at the time of your demise, and that can save capital gains taxes. So that's a concept that needs to be taken into account when we do estate planning. We may not have a federal taxable estate, but believe me, New York comes in and their exemption is much lower. And there's this particular trap called the estate tax cliff. If you're interested in hearing more about that, go to the second segment of our series. Today, we're going to really focus in on gifting strategies and the use of trusts. We're going to give you an overview today, and then we're going to follow up with more advanced tax planning and also planning for married couples at a later time. And lastly, we really need to understand what your asset allocation is, meaning if you're married, who owns those assets between the two spouses, or if you have jointly owned property, what the impact is of that. So what is a taxable estate in 2020? Because each year it's adjusted for inflation. Well, at the federal level, just understand the exemption amount is $11,580,000. So if your estate is over that amount, that excess amount will be taxed at 40%. Now, if you live in New York, in addition to that tax, New York taxes you on any amount over $5,850,000, and their tax rate, top tax rate is 16%. And if you have an estate of over $6,142,500, you get no exemption under the New York State exemption amount. You lose it once you're over the cliff. That's really bad news. So an example of the estate tax in 2020, if I'm at $5,850,000, zero taxes, that's awesome. That's the highest rate we've had at the New York level. If we hit that cliff amount, the $6,142,500, you're no federal tax, but your New York State estate tax, $528,240, $500,000, just by hitting that cliff. If you're at $11,580,000, great news, no federal tax. But look at this, New York State estate tax, $1,319,600. And if, for example, if your estate was in the area of 23 million, in my example, 23,160,000, the federal tax is $3,363,040. New York, $3,172,400, for a whopping $6,535,440. That is a lot of money in taxes. And if you have that kind of estate, you've worked hard to grow your estate. It just wasn't someone wrote you out a check for 23 million, unless you hit the lottery. So what do we do about this? Well, we do estate tax planning. If you have an estate of over 11,580,000, I urge you to do estate tax planning. You can still love the government, but you don't have to give them part of your estate when you pass. Also, if you believe that you have assets that are going to appreciate in the future, especially in a significant way, or that you're going to receive inheritances that may push you into a taxable estate, you need to do planning in advance. For example, on that inheritance, I have a client who came in the other day and told me she was going to inherit $3 million from her mother at some point in the future. Her mother's in her 90s. That would have pushed them into a federal and New York State estate tax situation. At 50%, now I know it might be something less than that, but at 50%, that's $1.5 million in taxes. So I said, let your mother do a dynasty trust and avoid the $1,500,000 tax in your estate if you inherited those assets. Also, here's a warning. The federal estate tax exemption may be lowered in 2021. We may see a changeover in Congress or at the president level, which results in the exemption coming down. Could come back down to the $5 million range. And by the way, in 2026, it's already scheduled to return to $5,900,000. So I've had a number of my wealthier clients contact me. What do I do? Should I make the gifts now using up my exemption? And the general answer is yes, if you're comfortable and you can afford to do it. So we're going to break this into 2 stages of planning. Stage 1, here are some ideas. Make gifts to individuals or to trusts. These are dollar for dollar gifts. I take $100,000, I give it to my children, and now that $100,000 reduces my estate. There's no New York State gift tax. I'll use up some of my exemption. I can give $15,000 away per person per year, so that is not counted against the exemption. And when I give that money away, if it grows in the future, it avoids tax. Very basic planning. I don't want my family members or friends to receive the money directly. I want to do it in a more protective way. I gift it to a trust. It can get you into a similar result with the estate planning. Life insurance trusts. This is a way of avoiding estate taxation on the life insurance while funding any estate tax due. Don't be misled that life insurance is tax-free. It's income tax-free. But if you own the policy, it's part of your estate. If I'm married, I want to think about taking advantage of credit, shelter, and marital trusts, either under my wills or through a revocable living trust. That way we take advantage of the exemption in both estates. And then asset allocation can be very important, especially when you're married, to make sure that you're using the exemption and not losing it in New York. So these are opportunities to do planning at stage 1 level. As I talked about the gifting concept, take advantage of the $15,000 annual gifts per person. So if you have 3 children and 7 grandchildren, you can give away $150,000 and it's not offset against your federal unified gift and estate tax exemption. Beyond that, you could start using the exemption up. And the benefit of that is twofold. One, you can use the exemption so that any growth in those assets after you gift them avoids estate taxation. Also, you're using up your exemption because we don't know whether that exemption amount is going to be available in the future. And the good news is there's no New York State gift tax to worry about. So the concept here with a gifting program is to reduce the size of your estate so that there's less to be taxed when you pass away. Makes sense. What are the best assets to use in a gifting program? Well, assets with little or no appreciation, because we're losing the step up in basis when we make those gifts. So for example, if I have a bank account with $100,000 and gift that away, there's no appreciation, it's dollar for dollar. Or I have a stock portfolio of $1 million. But let's say my cost basis is $900,000. That's relatively small amount of appreciation on that $900,000. That might be a good account of assets to give away. Think about assets that will appreciate significantly in the future. I had a client of mine own real property that was vacant, basically vacant land. But he was going to convert that into a mall. It was going to be worth a significant amount higher in the near future. That was a really good asset to give away when it was just land. And assets that you have no intention of selling. So let's say I have a second home in the Hamptons, and I want to have that home continue for the benefit of my children and grandchildren, so I don't worry about losing the step up in basis, even if it's appreciated significantly, because there's no intention of selling that asset. Or you may have rental property that's giving a nice rental income stream, and you would really want to carry that through for the next generation. Now, let me give you an example of a gifting program here, so you can understand the savings that you can achieve by being proactive. Let's say I have an estate of $11,580,000. Now I know, because I said earlier, there's no federal estate tax this year. Now, I'm not wishing anyone passes away this year, but this is the example. Look at that New York estate tax, $1,319,600. If I was willing to gift $5,730,000, it would reduce my estate to $5,850,000 for New York estate tax purposes, creating a zero estate tax. I went from $1,319,600 to zero. The tax savings, $1,319,600. Now, can I do the gifting in a smart way? Absolutely. You could make gifts into trusts, and there are various ways where you can maintain some control over those assets, protect it from creditors. There are a number of benefits utilizing trusts in a plan like this. Now, the gifts, if made today and you passed away today, there's the savings, but there's a qualifier. New York says that that gift has to be more than 3 years earlier than the date of your demise. So if I was to pass away in 2020, I would have needed to make that the gift that I'm suggesting here in 2017. So 18, 19, 20, I have to get past 3 years. So I wish everybody good health when they enter into a gifting program. We don't want New York pulling it back in. Now, I mentioned earlier planning with life insurance. So you want to remove life insurance from your estate. That's one of the first places I go when I look at an overall taxable estate. Gift the ownership of the life insurance policy to another person or to a trust. That other person should not be a spouse, because that probably is not going to work very well. The best place to transfer that life insurance policy is to an irrevocable life insurance trust. We can build in protections. We can name the trustee who's going to control ownership of that policy. The trust would be the beneficiary. Now, when the trust receives the money, if there are any estate taxes owed, they can use that life insurance proceeds. If we don't need to pay any taxes, it can be there for the benefit of your family. So, simple example, if I have a taxable estate, federal and New York, and I'm going to put that in at around 45%. If I have a 45% tax rate against that $5 million policy, by removing it from my estate, I can save $2,250,000. This is a relatively straightforward plan, not overly costly to implement, and we're looking at $2,250,000 savings. Now, when we start using up our exemption, we don't want to use it dollar for dollar if we can make more of the gifts. And what I mean by that is, can I give away $1 and have the government think I only gave away 65 cents? So that if I gave 65 cents away, then I used up less of my exemption than if I had given $1 away. Think about that in terms of hundreds of thousands of dollars or millions of dollars. So we want to do discount gifting, making the asset worth less for estate tax purposes. And here's a simple, straightforward example. If you own real property and you transfer a small amount, it could even be 2%, but you can even do a larger amount. When you fractionalize the ownership of real property, the value of your ownership is discounted by 15%, because in the marketplace, someone would be reluctant to purchase that property when there's a fractional owner. I own 98%. who would buy 98% of a piece of property with 2% owner sitting as a co-owner of the property. So it could be 10%, it could be 25% discount. It's approximately 15% as a conservative number. So there are a lot of tweaks that you can make in your estate that could save a significant amount of money. Now let's get into leveraged gifting. Discounting the value of the gift, making it worth less for gift tax purposes. So using less of your federal exemption amount is important because then you have an unused federal exemption amount that can offset estate taxes when you pass away. We have a unified federal and estate and gift tax system. So stage 2 gets into these kind of discounted gift strategies among a couple others. We can do discounted gifts using limited liability companies or subchapter S corporations. We can use discounted gifts to trusts, Grats and Cuperts. We can do dynasty trusts where we skip a generation. Let's say you have assets, and even if you don't have a taxable estate, let's say your child does. Why would you want to add more assets to their taxable estate? The dynasty trust. If we're married and we have a spouse and we like the idea of reducing the size of our estate, but we still need the income from those assets, you might want to consider a spousal lifetime access trust, a SLAT. Or if you're charitable minded, charitable gifting. And you can couple that with the use of trusts and also life insurance. So actually it can be a win-win situation. You can keep assets to pass to your family while also giving assets to a charity. So I call it the alphabet soup of estate tax planning. The GRATs, the grantor remainder trust, annuity trust, the Cuperts, the qualified personal residence trust, and the SLATs, the spousal lifetime access trust. So just like vegetable soup, we have these acronyms, and they're pretty powerful. And in my next webinar, I'll go into a number of examples of how powerful these planning strategies are. Also, we can couple that planning with the use of LLCs and S corporations. When you have a small business company, you can convert the ownership into voting and non-voting interests. And the non-voting interests will be discounted for lack of marketability and lack of control. And the typical discount will be anywhere from 15 to 35% or more of the value of that interest which you're looking to make a gift of. So let's say you had a limited liability company and you had a business worth $1 million. If you took that interest and divided it into, let's say, 2 voting shares or units, so you control the company, and gifted 98% of the company in non-voting units, those 98% non-voting units would be discounted by up to, in the area, 35%. So just doing math and keeping it general, if I made a gift of $1 million, it would only be treated as a gift of $650,000 with a 35% gift. And now I've used less of my exemption and I've saved estate taxes. On that $350,000, I used 50% just so I could do the math in my head. I just saved $175,000 for my family. And that's in today's value. You live an extra 10 or 20 years, those assets will grow and the savings can be enormous. So let me give you an example of another gifting strategy approach with the discounting. So let's say I have an estate of $23,160,000, and I've already told you the estate tax is $6,535,440. If I made a gift of $5 million into any one of these strategies with a discount, And that, in effect, made the gift for gift tax purposes only $3,250,000. My estate would go from $6.5 million to $5.3 million, creating a tax savings of $1,180,000. That is significant. Now, if I even made the gift at $5 million without the discount, I could save $480,000, $500,000. Here again, I go back to, you accumulated this wealth. Who do you love? How do you want to pass those assets to your family? Do you want to maximize what you pass on to them? If you do, you want to minimize taxes. If you want to minimize taxes, you have to do some planning. Now, if you're charitably oriented, you could make charitable gifts while you're alive. That also will reduce your income tax, and that'll give you a tax savings, and it reduces your estate. And you don't use up any of your exemption when you make charitable gifts. You could make charitable gifts to what are called charitable trusts. And there are two types, a charitable remainder trust and a charitable lead trust. A charitable remainder trust is a way of giving you an income stream during your lifetime, with the remainder passing to the charity. And you get a tax deduction saving income taxes. That could be a win-win situation. Another concept would be, if you're going to leave money to a charity upon your demise, you might want to leave qualified retirement funds. Let's say I have $1 million in qualified retirement funds, and I have a $10 million estate, and I want to leave 10% of my estate to charity. If I give them non-qualified retirement fund assets, that $1 million does reduce my estate. I'll have $9 million now, subject to a New York State estate tax. My children, though, will inherit $1 million of retirement account money and pay an income tax. And if they're in the 35% bracket, we just lost $350,000. The better way might be for you to leave the $1 million of retirement account money to the charity. The children inherit the $9 million. Yeah, there'll be a New York estate tax, but they'll avoid the income tax on that retirement account. They'll inherit $350,000 more than they otherwise would have. So there are significant benefits with income tax savings and estate tax savings in charitable giving. And there are strategies where you can even replace the money you're giving away through a replacement trust. And that's, the grand slam of baseball. We'll talk more about that in a later webinar. I also just always want to mention that there are really great non-tax reasons to do the planning. You want to pass your assets on to family without problems and without probate, perhaps, to save on the legal fees and court filing fees. So many families have issues. Why not leave it in the most protective way, so that if they have a bad marriage or a creditor problem, or you want to make sure it goes down the bloodline ultimately to grandchildren, you can do that through the use of a dynasty trust, special needs trusts, safe trusts. And also, if I'm concerned about long-term care expenses, maybe I want to purchase long-term care insurance, or think about utilizing trusts so that if I have to access government benefits in a worst case scenario in a nursing home, I've done that. I've taken care of it. We love the idea of passing assets on to family without problems. We hate when there's an estate issue or a trust issue. The fees go through the roof. Families are fighting. So we have a number of techniques that we use to make sure assets pass without those kinds of problems. So what did we learn today? One, there are strategies to save estate taxes, including gifting and the use of trusts. Two, you need to make a commitment of time, energy, and legal fees that are going to have to get paid. So yes, it will take time and energy. Yes, it will cost me money, but the savings, the estate tax savings can be enormous. And I've given you the most conservative view, because when you have an estate of 20 million, money doubles every 10 years at a 7.2% return. 20 million 10 years from now could be 40 million. And you tell me, oh, I'm going to spend it. And I know from experience, when you have that kind of money, it's hard to spend down $20 million. The scenario is the estate's going to grow. Well, it won't grow that much. All right, even at a lesser percentage, maybe it doesn't grow to 40 million. It grows to 30 million. Look what you have today and just think about what you owned 10 years ago and look at, in most cases, the appreciation that's occurred. So I could have ran numbers, saved you $1 million today, and I could have did a projection and said, well, if you live another 20 years, that $1 million savings could be 5 million, 10 million. And that's true. That's the reality. Lastly, you need to be comfortable with your estate planning. So I urge people never to take steps and then regret them later on. But I think the writing is on the wall. This is my own personal view at the moment, that in light of the significant deficit that exists in this government, in light of the pandemic and the enormous cost to the federal government of providing all the benefits that have been paid out in a whole bunch of different ways, either through the stimulus program or the PPP program, we could see taxes go up regardless of which party is controlling Congress. So just take all this into account, take a deep breath, think about your estate, and think about whether you want to take steps today to be proactive. Maybe you've done some planning already, but more can be done. And we stand ready to step in and help you save hundreds of thousands of dollars, if not millions. And with that, that's my overview. I hope it's been helpful as a guide. And let's see if there are any questions that have come in or through the chat. Ashley?
No, Vincent, I don't see any questions. Just a reminder for anyone on here, if you do have a question, use the Q&A box located on the Zoom toolbar. You can also send us through the chat function. And in Facebook world, you can drop us a comment.
All right, so I'm just going to jump in and ask a question. So the question is, I own a house and I have a taxable estate. Can I do anything with my house to save estate taxes? Yes, you can. It's the Qualified Personal Residence Trust. I want to give you an example. I have a 55-year-old client with a taxable estate, and they have $1 million home. They transfer that home into a Qualified Personal Residence Trust, a QPRT. And in that trust, it says you can live there for the next 20 years. Person's 55, they have a life expectancy of greater than 20 years. They say, great. Now I'm treated as the owner for 20 years. I get the tax deduction. No one else can take the home away from me. Once you outlive that 20 years, that home is no longer part of your estate. So what's the value of that $1 million gift to the trust? You ready for this? There's a 57% discount. That gift of $1 million is treated at roughly $420,000, 58% less. So now what happens? Well, that $1 million home, when I save a 58%, 580,000, think about a 50% tax, that's almost $300,000 in savings. And not to mention all the savings on the future appreciation of that $1 million home. I am positive that 20 years later, it's going to be worth a heck of a lot more than $1 million. So let's just assume I saved $300,000 on the discounted gift. And let's say that home turned into a $3 million home, additional $2 million. That's another $1.5 million in savings. I've saved $1.8 million for that family. So Cuperts can be very helpful when you have a family residence. Can it be done for a second residence? Absolutely. It can be done for a second home as well. So that's a little example of what you can do with the family residence. All right. Question from Priscilla. If a couple gives through a Cupid, what happens when the first dies? Well, it all goes to how the trust is written. If the trust says that both the husband and the wife have a right to live there, then that just simply would continue. And so it would be out of the, it would be kind of a 50-50 split, that if one spouse didn't outlive it, half of that residence would likely come back into the estate, and the other half would continue outside of the estate of the first to die, because that would be the living spouse's interest in the home. Often when we have married couples and we think about Cuperts, we do more than one Cupert. We might split them into two Cuperts. Also, we could have a second Cupert for the same property, where someone says, I want to hedge. I want to have a 20-year term and a 10-year term on my property. Or often we do that with grantor retained annuity trusts. And we take some of the money, usually brokerage assets, for example, and we put it in a GRAT, and we have multiple GRATs that hedges on what might happen in the future. All right, so hopefully, Priscilla, that was helpful to you. And thank you for being a client of our firm. Any other questions? Otherwise, we'll move to wrapping up.
I think we can wrap it up, Vincent.
Okay, so my last slide. Pay attention here. I like this one. Those who plan, look what the IRS might get and look at what you get versus those who don't. So give us the opportunity to help you plan for you today so that we maximize what you have for your family. We love saving estate taxes. So Ashley, you want to just conclude for us?
Yeah, I just would like to remind everyone, if you could please complete the survey that will pop up in the web browser when you leave the webinar. We'd really appreciate it. Love to hear your feedback. And as Vincent said, if you know of someone, or maybe you need help with estate tax planning or elder law or special needs planning, our contact number is on the slide there. We appreciate your referral as well. So thank you all for joining.
All right, everybody have a great day and be safe.
Thanks.